Hi friends, good evening all. Welcome back. So today let us start learning AS2, which is valuation of inventory. Okay. So this is a new accounting standard for you. But if you look at the history of the standard, it is very old, maybe more than 30 years old. One of the basic and traditional standards, probably it could be lengthy, but there are no complexities in understanding it. There are very, very simple basic principles. So it says simple. The whole standard says how to value inventory. This is the question. And the answer is value of inventory is the lower of A, cost, B, net realizable value. That's it. Cost or NRV, whichever is lower. So the whole standard is based on this. But how do we calculate cost is the focus of the standard. Net realizable value is normally the estimated selling price. Like, say, for example, you have some goods. At what price you are confident that you can sell it in active market? So you are a buyer, you are a seller. If you are a trader, you are buying and selling goods. So when you bought goods which are unsold on 31st March, that is what we call inventory. So when you have inventory of the finished goods which are held for trading, so because you are operating in that particular industry, you will have enough knowledge or enough experience to estimate the value of selling price. So I have 100 goods. Say, for example, I am a buyer and seller of, I am a trader of pens, ballpoint pens. So I have 1,000 pens in my hand. I know that I bought it for 3 rupees. I know that I'll sell it for 5 rupees. So 3 rupees is my cost price. And if there are any transportation, freight, insurance, or any storage expenses, some certain things can be added to this 3 rupees. Certain things cannot be added. Say, for example, after adding all these things, the pen comes to 3.5 rupees. So the purchase cost plus other cost that can be attributed to inventory is 3.5. That is what we call cost. Then NRV is at what price you can sell it. Say, for example, you can sell it at 5 rupees. Okay, then imagine you need to spend some expenses like selling expenses or the brokerage. You need to give some sales commission. For example, you need to pay 25 paise. So 5 rupees minus 25 paise is equal to 4.75. That 4.75 is net realizable value. Now simple, inventory value is cost 3.5, net realizable value 4.75, whichever is lower. Okay, which is 3.5. Then you have 1,000 pens in your hand, 1,000 into 3.5, 3,500 is the value of your inventory. That's it. It is this simple. But, as I continuously say, ICI has a beautiful art of complicating things, even if it is simple. So they will give a lot of information. For example, what is inventory itself will be explained in 5 pages. You don't need to explain anything, boss. Just say that inventory can be raw material inventory, work in progress inventory, finished goods, or loose tools, stores, and spares, depending on the accounting policy of the company. That's it. But yes, calculation of cost is not that simple. In different situations, how cost is to be calculated. Can we identify inventory and can we calculate the actual cost? If I cannot calculate the actual cost, then can I apply any cost formula? Like probably cost formula can be FIFO, cost formula can be weighted average method. If for practical reasons, these are not possible, then what are the probable other alternatives? Pawan sir, I am not able to apply FIFO or weighted average method. Do we have any other alternatives? Yes, ICA has given many alternatives for different situations. So that is what we are going to discuss in this accounting standard too. Okay, so we'll not spend a lot of time on too much of theory which is given by ICA, which is actually not required to that level. So in simple terms, we'll go. So if you look at it, asset-based accounting standards, which is chapter 5, in that unit 1 is accounting standard 2, which is valuation of inventory. And if you look at it here, 20 pages are there, 20 pages, but this standard can be written in 2 pages also. The standard can be written in 2-3 pages also. 20 pages is actually not required. So this is the introduction. Now, as I told you, we are not going line by line. Here, this is definition of inventory. This is definition of inventory. AS2 defines inventories as assets held for sale. Now, you're understanding one new phrase, assets held for sale. So now here write down assets held for. So there are two assets held for. From this two arrow marks down, assets held for from this two arrow marks down. One is use. Assets held for use. In brackets, for more than 12 months. For more than 1 year. So these are known as non-current assets or fixed assets. Assets held for use are non-current assets or fixed assets. Then assets held for sale. Pavan sir, this asset is held for sale. I just want to sell it. I just want to sell it. Then this is a current asset. So simple. Asset means that gives economic benefits. We have discussed in chapter 2, preparation and presentation of financial statements. In that, asset is a resource controlled by the entity, which is generated through one of the past events, which probably gives you future economic benefits, cash flows, or any other type of benefits by using the asset. So asset is equal to future economic benefit. Asset is equal to future economic benefit. So how you are getting the future economic benefit? So it is simple. It is simple. If you have a goat or if you have a tree, are you trying to get the agricultural produce like, say, for example, milk or eggs? Pavan sir, I will not kill the animal and sell it. I will just maintain the animal, feed the animal. Animal is my asset, and I will be selling only eggs. I will be selling only wool. I will be selling only milk. But I will not kill the animal or bird. I'm not going to sell it. This is the logic of machinery. Pavan sir, I bought machinery not to sell machinery, but to use machinery to develop some produce which will be sold. So the logic is here, animal or bird is your long-term asset, and that inventory, whatever the produce, agricultural produce or industrial produce you created out of it is your inventory. You are selling it. So here the buffalo is a long-term asset and you want to get future economic benefits by using it, but the milk is your inventory asset. You are holding it to sell. That means the future economic benefit of machine will come by usage. The future economic benefit of inventory comes by sale. Simple. Isn't it basic logic? The future economic benefit of buffalo comes by using it, not by selling it. The future economic benefit of milk comes by selling it, not by using it. This is the difference between current asset and non-current asset. Now, Chintu will get a question. Pavan sir, okay, I understand your point. I have a buffalo. I'm not selling it. I'm just taking the milk, extracting the agricultural produce, harvesting the agricultural produce, and I am not selling the milk. I am using the milk to develop another product. Say, for example, yogurt. Say, for example, curd. Say, for example, some sweet. You are using this milk in making some sweet. So I have 100 liters of milk today. That is my inventory, but I am not selling this asset. I am holding it, which is proposed to be used in another process to make another product. And finally, I'll be selling that product. I'll be selling curd. I'll be selling some kalakand. I'll be selling some sweet. I'm not selling milk. Then that is also your current asset because that will be consumed within one accounting year. So when you got production, when you got final product, either sell it as it is or use it in another production process, then it will become work in progress. That is the reason they say inventory has three basic items. One is raw material, one is work in progress, one is finished goods. And sometimes you will have certain accessories or spare parts which are purchased for a machine. Like, for example, you have lift or you have, a lorry. you bought certain items which will be used as accessories or which will be used as spare parts, which are, you're keeping it for a backup. Now, based on accounting standard 10, there are certain situations where the spare parts and accessories can be capitalized as a part of PPE. If accounting standard 10 says, Pavan, this asset 1 lakh rupees, I agree. But that 5,000 rupees of spare parts or accessories, whatever you bought now, that spares cannot be included in this main asset, Pavan, because the nature of the asset is such that it is inventory. Then I'll say, okay, dear ICI, I agree. If you say this is part of PPE, we will capitalize it as a part of fixed asset. If you say this is not part of PPE, okay, that will be inventory then. So that is the definition. So look here. Inventories are assets held for sale. Inventories are assets held for sale. Inventories are assets held for usage. Assets held for usage. In the ordinary, held for sale in the ordinary course of business or held in the process of production for such sale. That means this is work in progress. Then the third one is for consumption in the production. This is raw material. So first one is finished good. Second one is work in progress. Third one is raw material. Now, in raw material, they have included something, including maintenance spares, supplies, consumables, other than machinery spares, servicing equipment, and standby equipment, meeting the definition of PPE. That means if you have something which is meeting the definition of PPE, go to AS10. Pavan sir, I have some, consumables or some supplies which cannot be included in the value of PPE, considering the definition of PPE as per AS10, then come and treat it as inventory. That's it. So this is part one definition. Then from the scope of AS2, they have excluded certain things. What is that? Accounting standard 7 deals with construction contracts. So if you have any asset under construction, which is a construction property, say for example, apartment under construction, you cannot apply AS2 for that, even though, it is inventory for you. For example, you are a seller of apartment flats, you are constructing them, still you cannot use AS2 because for that AS7 is there. AS7. Next, work in progress of these people. Who are they? Service providers. There are certain service providers and there is some work in progress. For example, they have given one simple example, shipping company. So if you have shipping, if you have a shipping, if you are considering shipping company has a ship. And in the ship, there are certain parts, like, there are certain inventories like fuel, stores. So they are saying there are certain different guidelines for them. These are industry-based guidelines. Industry-based guidelines. So if you have any industry-based guidelines, don't come here. Use that guidance. Because this AS2 is in general given. It might not suit a specific situation. For example, consultancy, software, medical services, merchant banking. So probably they might have different, different guidelines for accounting. So one, for accounting standard 7, construction contracts under progress, which are construction is going in progress, don't use AS2. 2, work in progress in case of service providers, don't use AS2. 3, shares, debentures, other financial instruments held as stock in trade, because they are financial instruments or investments. You have accounting standard 13 for that. So don't use this. Financial instruments. Then producers' inventories of livestock. Livestock means animals and birds. Agricultural produce, forest products, mineral oils, ores, and gases. Sir, what all these things are? Again, there are two industries here. One is agriculture. For agriculture, we have a separate accounting standard. Maybe it is not in your generation accounting standards. It is in IND AS. IND AS 41 speaks about agriculture. IFRS 41 speaks about agriculture, which is not completely applicable in India, because India, we have not, agricultural sector has not grown to a level where accounting is systematized. So there are so many practices by these farmers, agricultural producers, they are following some traditional techniques. But in global accounting, even agriculture is considered to be one of the industries where accounting is systematized. Okay, so that is one. Second one is this natural resources like mineral oils, okay, mineral ores, gases and all. For this also, there is another accounting standard called Ind AS 106. which is not applicable for you. So these four are to be excluded. These four are to be excluded. That's it. This is what we call scope out. Okay, then they are giving all the blah, 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 blah. We'll come back to it later. So now look here. Simple. How inventory is to be valued? Raw materials, finished goods, and work in progress. So I'll give you 5 minutes of time. Write this in your notes. I know you have ICI beautiful study material, but I want you to copy and write this in your notes. I'm giving you 5 minutes. Once you write this in the chat box, say you are done, then we will start. Okay, in your notes, copy this, then we will start. So guys, this chart which I asked you to copy in your notes, if you look at it, there are two things. How do we value raw materials is given on the left hand side? How do we value finished goods and work in progress is written on the right hand side? So remember the rule, as far as raw materials are concerned, there is no cost or NRV whichever is lower. So for raw materials, it is always cost. For raw materials, it is always cost. You don't need to compare it with NRV. Now the question is why? You tell me why for raw materials, we are not comparing it with NRV. Simple, because if I have raw material in my godown, I am not just a trader, I am a manufacturer. Because trader buys finished goods, sells finished goods. A manufacturer buys raw material and prepares finished goods, correct? So the context is that you are a manufacturer and you bought raw material. And remember, a manufacturer who bought raw material never sells raw material. He only consumes raw material. For example, you are a construction contractor, for example, and you purchased cement. You are not buying cement for reselling. You are buying cement for using it in construction of building. You understand? So you bought diesel. You are not buying and selling diesel. You bought diesel to operate your machine, to operate your diesel generator set. These are the raw materials which are for consumption. So when you are thinking about net realizable value, what is by definition net realizable value? Net realizable value is the estimated selling price at which you will sell inventory. But this inventory, I never intend to resell at all because it is raw material. So I'll not sell it. I'll not sell it. That is the point here. So because I will not sell it, selling price is irrelevant. That is the reason you are not calculating net realizable value. Now, what is this replacement cost? Simple. Net realizable value means if I sell this item of inventory, how much I will get. This is net realizable value. What is replacement cost? If I am buying this inventory again today, how much do I need to pay? This is relevant for me because I buy raw material. So buying cost is important. I will not sell raw material. So selling cost is not important. That is the reason for raw material replacement cost. So what is the rule? In case of raw materials, value them always at cost. Value them always at cost, except in one situation. But if the finished goods in which this raw material is expected to be used is estimated to be sold at less than its cost, then raw material should be valued at its replacement cost instead of cost. Now look here. Raw material, say for example, 10 rupees. Raw material cost is, for example, 10 rupees. This I bought 3 months back. Raw material cost 10 rupees. This I bought 3 months back. Raw material replacement cost today is, say, for example, 7 rupees. So this I bought on 1st Jan 2024. This is on 31st March 2024. So I bought today, its price is 7, but I bought it at 10 2-3 months back. Should I book a loss? The answer is no. Should I book a loss? The answer is no. Why? Because you are not selling this, that sale price is irrelevant. But Pavan sir, what if I am manufacturing finished goods at a cost of 100 in which the above raw material is used? The above raw material is used. And finished goods selling price is 140. So profit on sale of finished goods is 40. So finally, you are using this raw material in some good which is giving you profit only, no? So what is the purpose of booking this 3 rupees loss, which is notional, which is not actual? This 3 rupees is not actual loss, no? You bought something for 10 rupees. This is there in your hand. You used it in something, and that something finished good is manufactured at 100, sold at 140. You enjoyed a profit of 40. So on 31st March, there is a fall in inventory value is irrelevant. Now, Pawan sir, what if in a case where I will use this raw material X in finished good Y, but the finished goods cost is 100, it will be sold at 80 rupees only. Final finished good will be sold at a loss. Then that is a problem. Prudence concept, conservatism and prudence. What did you learn in accounting standard? Prudence. If there is going to be, something bad in future, better you take a slap today. Expected profits, don't record. But if it is an expected loss, then you need to record that 3 rupees here loss. Because finally you lose 20 rupees. In that 3 rupees is because of this raw material. That is the reason we record. So what is the rule? The rule is raw materials are valued at cost. But if the finished goods are sold at or above, see, if the finished goods are sold at or above cost, that means you're breaking even or you're selling it at a profit, then value raw materials at cost. Otherwise, that means in a situation where finished good is sold below its cost, then you have to value raw material at replacement cost. Many students, do not understand the concepts in this depth, which is, in my opinion, which is required. So guys, do you understand raw materials? Very good. Then comes finished goods and work in progress. Simple. Cost, NRV, whichever is lower. What is cost? Cost comprises 3 elements. Cost of purchase, cost of conversion, other cost. Other cost means other costs which are directly attributable, like freight, insurance, sales commission, purchase commission. Net realizable value. Realizable value less selling expenses. Less less cost of completion. This is for work in progress. Pavan sir, it is in work in progress. So you need to complete that also, no? It is complete up to 70%. Remaining 30% you'll have to complete, no? That cost also you need to reduce. That's it. Then they have given some examples. I want you to do example. This is very old question. They have given net selling price. So Kalyani, can you read this example, ma?
Cost of a partly finished unit at the end of 2021-22 is rupees 150. The unit can be finished next year by a further expenditure of rupees 100. The finished unit can be sold at rupees 250, subject to payment of 4% brokerage on selling price.
You need to incur 4% brokerage on selling price. So what is the selling price of the product? 250. So can you calculate 250 into 4% how much? Hello, guys, 250 into 4% how much? Is it 10 rupees?
10 rupees.
10 rupees. Okay, continue.
Assume that the partly finished unit cannot be sold in semi-finished form and is NRV 0 without processing it further. Value of inventory.
So you have an item in work in progress which is not having a ready-made market. Say, for example, we give some banana examples here, like banana examples means chiller examples. Like, you have wheat. Okay, wheat is raw material. Okay, you are making chapati. Chapati is finished good, which you can sell. Now you have a dough. You have prepared that batter or dough, whatever you call it. In that stage, no one will buy. Either you sell wheat, people will buy. Wheat flour, people will buy. Okay, globally they call it flour, but we call it flow in India. So whatever it is, the basic that pindi you can sell, or you can sell chapati. Now, when the dough is there, no one might buy that. Then it's NRV. If no one is buying, NRV is zero. So simple. Pawan sir, what to do? Simple. Process this into a chapati, then only you can sell. That is what they are saying. Okay, now net selling price 250. Now you have incurred already 150 cost. That means another 100 rupees is the further completion cost. So 250 minus further completion cost 100. Okay, that means you have incurred 150 till today. From that, subtract brokerage. Net realizable value is 140. Cost of inventory is 150. So value of inventory is less of that to 140. Basic example they have given. Just read the question, read the answer. Okay, we don't need to really spend that much of time also. Cost of inventory, cost of purchase, cost of conversion, all these things are explained. Don't worry about that. They have given one example for fixed overheads that we'll see later. Joint products, byproducts, that also we'll see later. Conversion cost, this also we'll see later. Now let us go to, before cost formula or before something else. Let us look at some problems. Okay. Now, can you read this question, Ma, Kalyani? We are doing question number 1.
The company deals in three products, A, B, and C, which are neither similar nor interchangeable. At the time of closing of its account for the year 2021-22, the historical cost and net realizable value of the items of closing stock are determined as follows. Items A, historical cost 40, net realizable value 28. B, historical cost 32, NRV 32. C, historical cost 16, NRV 24 lakhs. What will be the value of closing stock?
So when you are comparing cost or NRV, whichever is lower, you have to do it item by item. You cannot mix all the items. So the cost of all the 3 items, NRV of all the 3 items, wrong. Each item you need to see. That means for item A, cost or NRV, whichever is lower, is 28. For item B, 32, same. For item C, 1624, so lower is 16. So now you take a calculator, calculate 28 plus 32 plus 16. It will be total value of the inventory. That is what is given in this table. For first item, 28. For second item, same, 32. For third item, 16. Put together, 76. So closing stock will be 76 lakhs. That is what the first question is. Now, can you read question number 2, please?
X Company Limited purchased goods at the cost of rupees 40 lakhs in October 2021. Till March 2022, 75% of the stocks were sold. The company
Wait. Out of 40 lakh rupees of goods you purchased means you are a trader. You are a trader. So you bought finished goods. How much? 40 lakhs. In that 75% sold. That means, can I say remaining 25% is not sold? That means on 40 lakhs, 30 lakhs worth goods you sold, 10 lakhs worth goods you have not yet sold. Continue.
The company wants to disclose closing stock at 10 lakhs. The expected sale value is rupees 11 lakhs and a commission at 10% on sale is payable to the agent.
Wait. This information is given to calculate NRV. How do we calculate NRV? Take 11 lakhs minus 10% commission, 1,10,000. So NRV is 9,90,000. So cost 10 lakhs, NRV 9,90,000, whichever is lower. So 9,90,000 is the value of inventory. The company says we want to value inventory at 10 lakhs. No, you cannot do that. What you need to do is cost is 10 lakhs. NRV. estimated selling price is 11 lakhs, less commission 10%, that means 1,10,000. Therefore, net realizable value is this minus this. Therefore, inventory is equal to lower of the above two. That's all. LKG question. So guys, all of you, do you understand this question? Can you please respond in chat box? Question number 1 and 2, do you understand? Simple questions. Okay. Now, let us go to question number 3. Can you read question number 3?
In a production process, normal waste is 5% of input. 5,000 metric ton of input were put in process, resulting in wastage of 300 metric ton. Cost per metric ton of input is rupees 1,000. The entire quantity of waste is on stock at the year end. Stock at the year end, state with reference to accounting standard. How will you value the inventories in this case?
So what is the concept here? Can you tell me, guys, what is the concept involved here? Normal loss, abnormal loss. So what is input material? Input material is 5,000 metric tons. Input quantity is 5,000 metric tons. Less normal loss. Normal loss 5% they said. So calculate 5% of above. 250. So this is what we call estimated output. Standard output. Estimated output is 4,750. Now what is actual output? 4,700. Now you tell me, what do you call this another 50 shortage? You thought 250 shortage will be there, but there is total 300 shortage. So this 50 is called what? Abnormal loss. So this 250 is normal loss. This 50 is abnormal loss. What is the rule? Normal loss, including cost. Abnormal loss, charge it to P&L as a loss. Normal loss actually forms part of cost. Abnormal loss should be treated as loss and to be charged to P&L. Simple. Normal loss is equal to unavoidable is equal to cost is equal to include in inventory. Abnormal loss is equal to avoidable is equal to because of your carelessness or irresponsibility. Customer will not pay for it. It is your inefficiency. Therefore, treat it as a loss and charge it to P&L. This is the concept. Okay. Now, for normal loss, you need to inflate the price. So, how much you bought? 5,000 metric tons you bought. What is the cost per metric ton? 1,000. So, input quantity, how much? 5,000 tons. Input price, how much? 1,000 rupees per metric ton. So, raw material cost, how much? This into this. It must be 50 lakhs. So, 50 lakhs worth raw material you bought. So, what is the estimated output? For this 50 lakhs, what is estimated output? 4,750. So what is price per unit? Price per unit, this divided by this. 1052. So this is the cost of good unit is equal to 1052.63. So what is your abnormal loss? Abnormal loss is equal to 50 units into each unit is 1052.63. Okay, so this is calculated as this into 50 units. Inventory is equal to 4,750 units into 1052.63. Therefore, it is 4,700. Sorry, inventory is not 4,750. Inventory is 4,700 only. you are able to get 4,700 only. So that is equal to 4,700 into this, ladies and gentlemen. So total raw material consumed is this plus this. So out of total 50 lakhs of raw material you purchased, you are able to use only 4,700. So abnormal loss is to be charged to P&L. So how many of you understand these calculations? Guys, if you understand, give me a thumbs up. Yes, bolo. Very good. Very good. So question number 4. Oh my gosh, there is only one more question. Okay. Can you read question number 4, Devika? Devika, can you read question number 4?
Yes, sir. You are required to value the inventory per kg of finished goods consisting of material cost per kg 200, direct labor 40, direct variable overhead 20, fixed production charges for the year on normal working capacity of 2 lakhs kgs is rupees 20 lakhs. 4,000 kgs of finished goods are in stock at the year end.
So now look here. Simple calculations. I told you, accounting standard 2 is basic. Even degree students or +1, +2 students, school students will understand the concept. So raw material, actual cost, wages, actual cost, variable or direct overheads, variable overheads, actual cost, fixed overheads, recovered based on normal production capacity. This is the rule. Pawan sir, what is this? Don't worry about this. I'll tell you in the next session. I'll tell you what is this. But raw material you're actually incurring, wages you're actually incurring, variable overheads you're actually incurring, but fixed overheads you are incurring for a period. You're not incurring for the product. So because these three are product costs, I am directly charging. Because this is not a product cost, this is a period cost, I need to recover it. I paid rent for 1 month, 1 lakh rupees, but I did not pay rent for this particular item of inventory, no? You understand? That is the logic. So what is this actual given 200? What is this actual given 40? What is this actual given 20? What is this fixed production charges? 20 lakhs is the cost. Then 2 lakh kgs is the output. So we are recovering 20 lakhs is the cost divided by 2 lakh quantity. That means if the company has spent 20 lakhs fixed cost and if it has 2 lakh units, what is apportioned fixed cost per unit? So is it 10 rupees? So total cost. How much? This is cost per unit, 270. Total number of units in inventory. They have given, the company has 4,000 units in hand, 4,000 units in hand, 4,000 kgs. So total inventory value is equal to this into this. That's all, ladies and gentlemen. 10 lakhs 80,000 is the value. So look here, that is what they said. 40. This is material 200, direct labor 40, variable overhead 20, fixed overhead at 10, total 270. 270 into 4,000 kgs is 10 lakhs 80,000. That is this answer, ladies and gentlemen. And after this, they have given test your knowledge. They might have probably given some questions here. Okay. So read these questions, try to solve it yourself. Okay. My charger is 0, my battery. We'll see you in the next session. Okay.